Hi, welcome to the Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest energy updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at 10 a.m. and 7 p.m. Eastern Standard Time. And here at the Crypto Republic, we give you the bird's eye view, a satellite perspective to spot the big picture shifts while everyone else is stuck in the daily chaos. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Listen carefully, because what I'm about to break down may change the way you look at this market. Most people right now are focused on price, short-term moves, noise. But underneath all of that, something bigger may already be starting to unfold. And if you understand it early, you may be able to see what others are missing before it becomes obvious. Because banks don't watch hype, they watch infrastructure, they watch settlement, they watch liquidity. And right now, there are growing signals that institutions may be paying closer attention to how systems like this are evolving. This isn't just about price, it's about positioning. And positioning often shifts before the broader market fully understands what it's looking at. Welcome back to the Crypto Republic, ladies and gentlemen, where we don't chase noise. We focus on what's actually being built, because price moves fast, but infrastructure builds slowly. And today, we're going to break down why XRP may be showing up in a much bigger conversation. Not just crypto and global finance, but payment systems, liquidity, and how financial infrastructure could evolve over time. Because when institutions begin to pay closer attention, it's usually not random. It's usually because something underneath may be shifting. Ladies and gentlemen, I just want to thank everyone that takes the time to like, subscribe, comment, and share these videos. These couple of things really do help the channel. And let's get to it today. And I hope you enjoy the content. Let's dissect it. Now, step back for a second. Forget XRP, forget crypto. Look at the system we're all operating inside. For decades, money has moved the same way, and most people never question it. When you send money across borders today, it doesn't just go from point A to point B. It moves through layers, banks, correspondent banks, clearing systems, settlement networks. Each step takes time. Each step adds cost. Each step adds friction. Now imagine running global trade on that system. Trillions of dollars moving through pipes that were built decades ago. This is why cross-border payments can take days, not seconds. Days, let that sink in. And that's not because technology can't do better. It's because the system hasn't fully evolved yet. But here's where it gets interesting, because systems like this don't stay inefficient forever. Think about electronic trading. There was a time when trades were executed manually, on floors, with paper, people shouting orders, chaos. Then came digital systems, faster execution, better efficiency, lower costs, and eventually that became the standard. The same thing happened with the internet. At first, optional, then unavoidable. Now, we may be watching the same kind of transition, but this time it's happening with money itself. And this is where XRP enters the conversation in a very specific way, because XRP wasn't designed to be everything. It was designed to solve a particular problem, moving value efficiently across systems, across borders, without the same level of friction. Instead of routing transactions through multiple intermediaries, you introduce a bridge, a liquidity layer that allows value to move and settle quickly. That's the idea. And this is what most people overlook. Because when institutions look at systems like this, they're not thinking like retail investors. They're not asking, can this pump? They're asking, can this reduce costs? Can this increase efficiency? Can this integrate with existing systems? Is it compliant? Is it compliant? Those are completely different questions. And that's when, is it compliant? Those are completely different questions. And that's why when you start hearing signals that institutions may be paying closer attention, it matters. Not because something is guaranteed, but because the evaluation process may be happening. But the real shift may not be XRP alone. It may be the infrastructure being built around it. Because when you look at Ripple's direction, it's not just one product. It's multiple layers: custody, payments, liquidity, treasury systems. When you combine those, you start seeing something bigger forming. Not just a tool, but a system. And in finance, the system matters more than the asset sitting on top. Now, this is where things start to connect. Because at the same time, governments are shifting. There's more discussion now around digital asset frameworks, compliance, integration, because ignoring this technology long term may not be an option. Countries are competing, financial systems are evolving, and whoever adopts faster may gain advantages in efficiency and capital flow. This is no longer just about crypto, ladies and gentlemen. It's about financial leadership, payment dominance, global positioning. Let that sink in, because this is massive. This is what everything's about. And this brings us to one of the most important concepts: payment rails. Let that sink in. These are the systems that move money globally. And right now, they're being questioned, not replaced overnight, but evaluated. Can that be faster, more efficient, more connected? That's where blockchain-based systems come in. So the question becomes, if new rails are being explored, what sits between them? Liquidity, settlement, bridging. That's where XRP is often discussed, not as the only solution, but as one designed specifically for that function. But here's where it gets even more interesting. Let's ask a simple question. What if even a small percentage of global payments began moving through more efficient systems? Not all at once, just a fraction, 5%, 10%. What would that do to the demand for liquidity, to settlement systems, to the asset facilitating that movement? Think about that for a second, because this is where the conversation shifts from price to utility, from speculation to function. Some analysts believe that if adoption continues, valuation frameworks could shift over time. But again, that depends on real usage, not theory. Price is reactive. The system's evolving. Now let's stay grounded. Nothing here is guaranteed. Markets move in cycles. Adoption takes time. Infrastructure takes time. Institutions move slowly for a reason. They test systems, run pilots, evaluate risk, then scale. But when they move, they don't move small. And XRP is not alone. There are multiple technologies that are trying to solve this problem. What matters is who gets integrated, who gets used, who becomes part of the system. Because in finance, integration beats innovation alone. And right now, we may be seeing alignment, infrastructure being built, regulation forming, institutions observing. When those layers begin to line up, it's worth paying attention. Short-term noise, long-term structure. So when you hear that XRP is being watched more closely, don't just think about price. Think systems, think infrastructure, think positioning. Are institutions watching XRP or watching what it represents? If you got value from this breakdown, hit the like button. Subscribe if you're part of the Wolfpack. Drop a comment where you're from, because in this market, clarity matters. And conviction, that's what separates observers from participants. Stay sharp, stay disciplined, stay Gucci, and don't get cut up like sushi. Happy Saturday, everyone. I hope everyone's enjoying the weekend. Ladies and gentlemen, XRP is moving beyond its own ledger faster than most observers are tracking. In the past week alone, the token's been bridged with Solana. That's massive. The other thing that I'm paying attention to, 7 billion XRP withdrawn from the exchanges in February, the largest monthly outflow since November 2025. Whether that signals accumulation, rebalancing, or simply de-risk, that's left to open, but it underscores that large holders are quietly moving coins off public markets. This is so massive, and other things go along with this. Ripple's now licensed in many U.S. states. They hold a New York BIT license, and they recently secured a major payment institution license in Singapore. That's massive. Singapore is like the Switzerland of Asia. Again, Singapore came out and said they won't take sides if there's a conflict between China and America, the United States. They're aiming to be that go-to place where you can move money quickly whenever you want, however you want. This is XRP and Ripple, ladies and gentlemen. The U.S. SEC has moved to establish its own node on the XRP ledger and other open permissionless blockchains. The SEC didn't call Ripple and say, can we have permission, underscoring that XRP's infrastructure is being treated like public internet plumbing, even as the agency has sued Ripple in court. Ladies and gentlemen, in a nutshell, regulators and banks are not ignoring crypto rails. They are moving onto them, legislating around them, and in Ripple's case, potentially using XRP as an invisible liquidity infrastructure under a fully regulated front end. Ladies and gentlemen, there's so much happening right now that if you start paying attention to the things, at least I'm paying attention to with this, and I'm telling the people that retain any capacity, that's massive. This is happening every day. To me, the biggest and most important thing is how much XRP is taking off exchanges. See, when money flows into XRP ETFs, we saw the SoFi news. That's massive. Again, I know a lot of people are upset about SoFi's news with XRP because you can't take off the XRP into your own cold storage wallet. Hence, not your keys, not your crypto. I get it, right? But as more people get access to XRP in any shape or form, it's like walking through the door of a mall, as far as I'm concerned. Once you're through and you see the entire ecosystem, that just leads you further down to get more exposure in a different way. That's what's happening. And it's happening every day. Again, if there's less XRP around to be had, price will move higher. I went over in a previous video. If you're new here, I welcome you. When we get to the rant part, it builds off of yesterday's rant. I don't really put much stock into what banks say with price predictions because banks don't want anything good for us as far as I'm concerned. This is just my opinion, not professional advice. You see there's a very big debate going on over stable coins again and yields. So I don't really think they want anything good for us. But if you can see where this is going, they're at the same time debating this in a governmental arena, but also from a business standpoint, they're doing something else. So as financial mercenaries, we're always paying attention to everything. Again, that's the most important thing. See, as the remora, we are underneath the apex predator and we're doing what they do. We're feasting on the sushi. And it's a fantastic way to play this because we get a free meal when we clean the shark's mouth and we're protected. It's a phenomenal symbolism. But ladies and gentlemen, money is moving and most people are watching the wrong thing. They just are. There's a very dangerous idea floating around the markets right now that this is a normal cycle. It's not, because when you zoom out and you're not on price, but you're on flows, positioning, and cross-asset behavior, you start to see something that almost never happens. You got stocks grinding higher. You got gold putting in multi-year strength. Commodities quietly outperforming bonds, not doing what they're supposed to do. And underneath all of that, a tidal wave of capital moving in ways that most people aren't even tracking. This isn't a market driven by narratives. This is a market driven by positioning imbalances and capital flows. And if you don't understand that, you're not early. You're liquidity. Let's start with the raw data, because this is where it gets really uncomfortable, ladies and gentlemen. Over the past year, 1 trillion annualized inflows into equities, 434 billion into investment-grade bonds, continuous inflows into commodities and gold, and 19.8 billion pulled out of cash into a single week. Think about what that actually means. This isn't cautious capital. This is forced reallocation. And when you look deeper, private clients are sitting at 65% equity exposure. That's massive. That's the highest since 2021. Cash levels are near cycle lows. ETF flows are accelerating faster than individual stock ownership. This is not organic investing behavior. This is systematic structural deployment of capital. And when that happens, markets stop behaving rationally. They start behaving mechanically. Now, here's where most people get it wrong. Again, this is not a rally like what you would think. They look at this environment and they say everything is going up, so everything must be strong. No, wrong answer, wrong opinion. That's how you get cut up like sushi. Everything is going up because money is nowhere else to go. We always talk about how money cycles. We were telling you before how banks are recommending people take money out of gold into Bitcoin because they want to be part of that asset. They want to be part of that action. They see this. Money cycles to the place of least resistance. But let me go over something more critical with you. So year to date, oil is 60 to 70% returns. Commodities, 50% returns. Gold, 9%. Stocks, mid-single digits. Let that sink in. That's massive. Bitcoin, negative on the year, but it's trending higher. We like Bitcoin right now. We're going long on Bitcoin for a little while right now. We like that. This is not a risk-on environment. This is a real asset rotation. And historically, when commodities lead like this, it's not because growth is booming. It's because inflation pressure is structural. So here's the hidden signal that we're watching, not financial advice, just my opinion. Ladies and gentlemen, money right now is going into a bunch of places. It's going into commodities, chips, China, consumer cyclicals, and curve steepeners. This isn't random. This is a macro playbook. Because if you believe global manufacturing is reaccelerating, supply chains are being weaponized, governments are backing strategic industries, then you don't buy narratives. You buy positioning ahead of flows. And that's exactly what we're seeing. Semiconductors, for example, are now the most overbought relative to their 200-day average since the year 2000. Let that sink in again. Not 2021, not 2017, 2000. And historically, when that happens, it doesn't end slowly, it ends violently. Now, here's where it gets even more dangerous. Again, and I was going over this with the family office because nothing is making sense right now from looking at charts. Because if you just look at sentiment indicators, you think everything is fine. So if you look at bull and bear indicators, 6.3, that's neutral. Breadth, 75% of markets are overbought. Flows are still positive. So the surface level conclusion is not extreme yet. But that's exactly the trap, because markets don't break when everything looks extreme. They break when positioning is crowded. Liquidity is one-sided and catalysts are ignored. Right now, we have all three. Okay? So let's talk about something almost nobody's connecting: corporate employment. So for the first time since 2016, S&P 500 companies reduced headcount in 2025. And at the same time, youth unemployment is globally elevated. Consumer confidence is near multi-decade lows. But here's the twist. Payroll growth is accelerating in 2026. EPS growth is rising alongside of it. This creates such a paradox, it's massive. Ladies and gentlemen, if jobs improves, it leads to bond sell-offs, which lead to yields rise. If yields rise, valuation pressure hits equities. So the very thing that supports earnings, that's fueling the market, also becomes the thing that breaks the multiple and cuts everyone up like sushi. Let's talk about something that should not be happening: a simple allocation. 25% stocks, 25% bonds, 25% cash, 25% commodities. This portfolio is up 26 annualized right now. That's crazy, 26%. That's the best performance since 1933. You got to write that down. That's massive. One of the largest outperformance gaps versus 60-40 in history. This is so massive. You got to write this down. This is not normal, because normally stocks and bonds offset each other. Commodities are cyclical. Cash drags. But right now, everything is contributing, which means one thing: we are not in a normal regime. We're in a transitional regime. Again, this is the geopolitical layer that nobody prices correctly. Markets are quietly pricing something much bigger: resource control, chip dominance, energy security. Because the reality is the next decade's not about efficiency. It's about control of supply chains. And when that becomes a priority, commodities outperform. Strategic industries get subsidized. Capital flows become political. This is why energy flows are accelerating. Industrial ETFs are being bought. Utilities are being sold. The rotation is not random. It's policy driven. This is the real risk nobody's talking about. Everyone's focused on risk, recession risk, inflation, central banks. But the real risk is much simpler: crowded positions in a liquidity-driven market. Because when equity inflows are at a record pace, bond inflows are also at a record pace. Cash is being drained. You don't have diversification. You have correlation waiting to spike. And when that happens, everything that went up together starts moving down together. So where does this leave us? You got record inflows, overbought global equities, commodity leading, labor stabilizing, yields threatening to rise. This is not a crash setup. This is a volatility setup. And historically, when you enter the fourth year of strong returns, war cycles, peace cycles, bubble cycles, they all end up the same way, unfortunately, with volatility spikes. This is the key takeaway, ladies and gentlemen. This is massive. This is a flow-driven market right now, not a fundamentals-driven one. Record inflows into both stocks, bonds signal forced allocations, not conviction. Commodities leading equals structural inflation and geopolitical shift. Overbought conditions across global equities, increasing fragility. This could go tumbling down, not at financial advice, just my opinion, ladies and gentlemen. So the biggest risk is not recession. It's crowded position plus liquidity reversal. What I'm watching right now, ladies and gentlemen, and retains at a capacity: equity inflows. Does the 1 trillion pace accelerate or stall? Bond yields, especially the 2-year and 30-year reaction to payroll strength. Commodity leadership. Does it broaden beyond oil and metal markets? We're also watching certain indicators. Does the 88% sell signal trigger? Labor data sustain payroll strength versus weakening consumer. Why this is important? Because this is the kind of environment where average participants think it's safe. Professionals get defensive, and positioning becomes the story. If you understand flows, you see turning points before price reflects. If you don't, you experience them after the fact. And in this market, the difference is everything. This is exactly what I'm talking about, ladies and gentlemen. One good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research and, more importantly, how to actually position, come and join us. We're over 500 active traders and investors inside the Crypto Republic Desk monthly. Ladies and gentlemen, these numbers are so important. And if you need to slow that down right now, because we're watching the flows flow in and flow out. This is what's happening right now. Ladies and gentlemen, there's a number nobody's talking about right now. Not the price, not the headlines, not the silver's down 35% narrative that's floating everywhere. I'm talking about a number that actually matters, 762 million ounces. That's how much silver has quietly disappeared from global inventories in just 5 years. Not traded, not rotated, not rebalanced, consumed, absorbed, gone, and somehow the market is acting like nothing is happening. That disconnect between what the price is telling you and the physical reality screaming is where the real opportunity lives. Today, I'm going to break down exactly why that disconnect exists, why it's getting worse, and why the people who understand this early don't need perfect timing. They just need positioning. Right now, silver is roughly trading at 35% below its all-time high. Most people see that and think weakness. But here's the problem with that interpretation. The fundamentals are tighter today than where they were at the highs. Let me say that again. When silver was making all-time highs, the physical market was looser than it was right now. And that should not happen in a rational system. But markets are not driven by one clock. They're driven by two completely different timelines. The financial market clock, faster, emotional, narrative-driven. The physical market clock, slow, mathematical, unavoidable. Right now, those two clocks are completely out of sync. The financial side's reacting to dollar strength, futures positioning, ETF outflows, risk settlement. But the physical side is dealing with something much more rigid, a structural supply deficit that is getting worse every single year. Let's talk about the actual numbers. In 2026, the silver market is projected to run a deficit of 46.3 million ounces. That's not unusual anymore because this is now year 6 in a row. 6 consecutive years where demand has exceeded supply, and here's where it gets more interesting. Demand is actually expected to decline slightly this year, and yet the deficit's growing. That tells you everything you need to know, because when demand softens, supply contracts faster. The result is not balanced, it's tightening. And when tightening in commodities doesn't show up immediately in price, it shows up first in inventory drawdowns, lease rate spikes, availability stress, which is exactly what we've been seeing. Let's look at oil inventories, because this is where things stop being theoretical. Global markets have been filling this supply gap by pulling from existing stockpiles, where the 762 million ounces comes from, and inventories are not infinite. They're a buffer. And buffers, once depleted, don't gradually fail. They snap. And look at what's happened recently. In one of the most important hubs, London vaults, at one point only about 17% of silver was actually available for delivery. Not owned, not accounted for, available. This is a liquidity problem, not just a supply problem. And when market liquidity dries up in a physical market, price doesn't gently adjust. It reprices violently. Yes, the availability has improved recently, but here's the key takeaway. It improves because conditions relax temporarily, not because the structural problem was solved. That distinction matters because temporary relief often sets up the next squeeze. A lot of people assume high prices fix shortages. That works in some commodities. It does not work well in silver. Why? Because roughly 2/3 of silver production is a byproduct. It comes from mining, copper, gold, zinc. That means silver supply is not directly controlled by silver prices. You don't just flip a switch and produce more. You need new projects, long permitting cycles, capital investment, favorable conditions, entirely different metals. That's not a short-term solution. That's a multi-year lag. So when deficits emerge, they don't self-correct quickly. They compound. Demand's not going away. Let's talk about the other side of the equation, demand. Silver is not just a precious metal, it's an industrial necessity. It sits at the center of solar energy systems, electric vehicles, semiconductors, manufacturing, advanced electronics, and these are not cyclical fads. They're structural investments, themes backed by government policy, corporate capital, long-term investment cycles. At the same time, silver also plays a monetary role, which means it benefits when currency confidence weakens and real yields fall. Financial stress rises, so you have two demand engines, industrial steady growing, monetary volatility explosive when triggered. And when those two align, that's when markets move fast. So this is the signal most people are missing. Well, everyone's focused on price. Look at what's happening underneath. Exchange inventories are down massively over the past few years. Physical availability has shown signs of stress. Retail demand is picking up back. The deficit's widening despite soft demand assumption. These are not opinions. These are conditions, and conditions matter more than narratives because narratives change quickly. Conditions don't. So what this actually means, it leaves us in a situation where the physical market's tight, financial market is weak, and the two are disconnected. This is not a permanent state. One side eventually corrects, and historically, it's not a physical market that adjusts to sentiment. It's the price that adjusts to reality. Here's the bottom line. You're looking at a market where supply cannot respond quickly. Demand is structural, supported. Inventories are being depleted, and price is not being driven by short-term financial noise. The combination doesn't show up often, and when it doesn't stay mispriced forever. The people who win in these environments are not the ones who react fastest. They're the ones who understand what's actually happening before the narrative shifts. Because by the time everyone agrees, the move is already underway, and at that point, you're not already positioning them or you're chasing. Ladies and gentlemen, if you want to stay ahead of how all this is affecting everything and evolves, this is exactly what we're tracking inside the Crypto Republic desk. Real-time shift, positioning, and how to navigate as it unfolds. The goal isn't to react, it's to be positioned before the move. One good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research and learn how to take advantage of all this, come and join over 500 active traders and investors inside the Crypto Republic desk monthly and our Patreon. Welcome all new members. There's so much happening right now. And again, none of this is financial advice, just my opinion. You want to learn how to be a financial mercenary, do come and join us. Doesn't matter if you have no experience or you're a seasoned veteran. There is so much happening right now. You see it. The biggest things that no one ever thought. The east side of the tranche made a big miscalculation when they thought that the west side wouldn't respond to the assault on the U.S. Treasury system and the dollar. The assault was something that the East could never see. Ladies and gentlemen, enjoy your weekend. This content's for information, entertainment purposes only. Should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions always. Remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You got two choices. You can be like the crowd reacting after the move, rationalizing why they missed it, telling themselves to never let it happen again, or you could be the one who saw behind the curve, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet right up until the moment they're not. And this is one of those moments. Do not blink because the world distracts you with noise. Well, XRP continues to develop behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. If this opened your eyes, smash that like button, ring a bell. Leave a comment with your thoughts, turn on notification, and most importantly, subscribe to the Crypto Republic. We break down the major global banking trends today, shaping digital assets, giving you content, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the Republic. I love you all. See you tomorrow.